All right, let's jump right in. Today, we're going to unpack a business concept that honestly affects all of us, whether we realize it or not. We're talking about the subtle, but really crucial, difference between a sales return and something called a sales allowance.
You know the feeling, right? We have all been there. You get that thing you were so excited about, you get it home, you open it up and something's off. Maybe it's broken, maybe it's the wrong color, maybe it just wasn't what you hoped for. And that little pang of buyer's remorse starts to set in.
But here's the thing. For us, it's just a moment of disappointment. For the business that sold it to you, that exact moment is a fork in the road. It's a single event that can lead them down two completely different paths, each with its own inventory, their accounting, and their bottom line.
So let's start with the path we're all most familiar with. Path number 1, the full refund. In the world of business and accounting, this is officially known as a sales return. So what exactly is a sales return? Well, it's pretty much what it sounds like. It's when you, the customer, bring a product back to the store because it's defective or you're just not satisfied with it. And for the company, that sale is now gone. Proof. It's a direct reduction of their revenue.
The whole process is super straightforward, and you've probably done it a dozen times. Step 1, you realize you're not happy with the product. Step 2, you physically take the item back to the business. And Step 3, the business gives you your money back, a full refund. Simple as that.
And here it is, the single most important thing to remember about a sales return. The crucial point is that the physical item, the actual goods, go back to the business. It's now their problem again. They have to deal with it, restock it, try to fix it, or maybe just count it as a total loss.
But what if there's another way? This brings us to path number 2, which is basically a price cut. And this introduces us to a really interesting concept called a sales allowance. Now, a sales allowance is a completely different kind of deal. This happens when a business offers you a price reduction, a partial refund, and in exchange, you agree to keep the product, even with its flaws. The key here is that the item never, ever goes back to them. Let's walk through a classic example to make this crystal clear. Okay, step 1. Imagine you buy a brand new table, but when it's delivered, you notice a small scratch on the surface. You're annoyed. Step 2, you call the company and instead of arranging a return, they say, hey, how about we give you 20% of your money back? Step 3, you think about it. For that discount, you can probably live with the scratch. So you agree, you take the partial refund, and you keep the table.
And this is the perfect contrast to the sales return, isn't it? For a sales allowance, the crucial point is that the goods stay with the customer. The business avoids all the hassle and cost of a physical return, and the customer gets a nice discount. It can actually be a win-win in a bad situation.
Okay, so we've walked down both paths. Now let's put them side by side to really hammer home that key difference. It's all about where the product ends up.
It really all boils down to one simple question. What happens to the item? With a sales return, the goods go back to the business for a full refund. With a sales allowance, the goods stay with the customer for a price cut. That is the fundamental difference right there.
So you might be thinking, okay, got it, one goes back, one stays. But why is this distinction so important? Well, trust me, for a business, this is about so much more than just a single lost sale. This data is an incredibly powerful tool.
So why on earth would a company bother tracking these two things separately? Because they tell completely different stories about what's going wrong. A high number of returns on one product might scream manufacturing defect, but a high number of allowances could point to a problem with a shipping company that keeps damaging things. By tracking this data, businesses can spot problems with their suppliers, monitor quality control, get a real pulse on customer satisfaction, and keep their financial reports accurate. It's vital business intelligence. Think about it this way. If a bunch of people are returning a new TV, it probably means something is fundamentally wrong with the TV itself. The screen is bad, the software is buggy, it's a bad product. But if a bunch of people are getting allowances for that same TV because of cracked screens, well, that tells a different story. The TV might be great, but it's getting damaged in transit. That's a shipping problem, not a product problem. See the difference? Two totally different issues needing two totally different solutions.
And all of this leads to a really fascinating strategic question for any business. When something goes wrong, what's the better bad outcome? Is it a return, where you lose the entire sale but you get your inventory back? Or is it an allowance, where you keep part of the sale but you know there's a flawed product out there with your brand name on it? It's a tough call, and it's a decision businesses have to weigh every single day.